The holy grail of crypto is to create a truly decentralized digital currency that could rival fiat currencies like the US dollar. In other words, the holy grail of crypto is to create a truly decentralized stablecoin. Over the years, we've seen many decentralized stablecoins, and most notoriously Terra's USDe, fail with disastrous consequences for the crypto market. However, this hasn't stopped crypto projects from trying. Ethena is one of them, and its USDe stablecoin has grown to a market cap of over $2.5 billion in a matter of months. And this has everyone wondering if Ethena is the real deal or another disaster waiting to happen. Today, we're going to find out. Stay tuned. I'll start by saying that nothing in this video is financial advice. It's purely educational content intended to inform you about Ethena. And I'll also note that at the time of making this video, nobody on CoinBureau's team holds ENA as part of their personal portfolios. And of course, this video is not sponsored in any way, so you know we will be as objective as possible, as always. If you're curious about the cryptos we hold and which ones we have on our watch list right now, you can become a member of the CoinBureau Club. More info about that in the description. With all that said, the history of Ethena begins with BitMEX co-founder and former CEO Arthur Hayes. After the collapse of Terra's UST in 2022, Arthur published a blog post titled, quote, Luna Brothers, Inc., where he proposed a design for a decentralized stablecoin that would be resilient to market volatility. An investment manager named Guy Young read Arthur's blog post and reached out, offering to basically build this decentralized stablecoin. Arthur agreed, and Ethena was born. A Portuguese software company called Ethena Labs was created to build it, though this only seems to have happened in 2023. In any case, Ethena Labs went on to raise $6.5 million in 2023 from crypto VCs and exchanges. It raised an additional $14 million earlier this year in a round that included TradFi giants like Fidelity and Brevan Howard. It seems the Ethena Foundation was set up as a non-profit around this time as well. Regardless, Ethena's USDe stablecoin launched in February, and its ENA governance token was airdropped in April. USDe's market cap went parabolic during this period, nearly hitting $4 billion. Its market cap has since shrunk to $2.5 billion, but USDe has managed to maintain that dollar peg. But before we look at how Ethena works, it's helpful to understand the motivations for creating it. Once upon a time, the banking sector wasn't keen to work with companies in the crypto industry, particularly crypto exchanges. And some would say that this is still the case today, but that's a topic for another time. Now, being blocked from the banking system created a huge incentive for the crypto industry to develop what was essentially a parallel banking system for itself. This resulted in the launch of Tether's USDT in 2014, which became the de facto bank account of crypto and the most popular trading pair. There's just one problem, and that's that USDT is centralized. Now, for those unaware, all centralized stablecoins are backed by an equivalent amount of assets, typically US bonds, aka debt. And these assets could be seized or, in the case of Circle's USDC, rendered inaccessible in a banking crash. Thankfully, SVB was bailed out. In theory, the solution is to create a stablecoin that's backed by a cryptocurrency like BTC. In practice, though, this model is too unstable because cryptocurrencies are very volatile. If the value of the crypto back in the stablecoin falls too much, it could result in a Terra-style doom loop that results in billions of losses. But what if there was a way to create a decentralized stablecoin that was in the middle, not reliant on banking rails, but also not backed by a volatile crypto asset? This is Ethena's approach, and it effectively involves using a network of exchanges, market makers, and custodians to maintain USDe's dollar peg. And by the way, if you're enjoying this video so far, be sure to smash that like button, subscribe to the channel, and ping the notification bell as well so you don't miss the next one. Now, this ties into how Ethena works. And if you're watching this video because you tried understanding how Ethena works using other resources, chances are it's because they said stuff like USDe is a tokenized cash and carry trade or a delta neutral trading strategy. Obviously, only TradFi folks understand this. So it's clear that Ethena is really complicated, but we are going to keep our explanation super simple by breaking it down into its key components. The first component of Ethena is futures trading. In plain English, futures allow you to bet on whether the price of a crypto will be higher or lower in the future. And if you're betting that the price of a crypto will go up, that's called going long. If you're betting that the price of a crypto will go down, well, that's called going short. Now, both can be done with leverage, which is extra borrowed money. But Ethena doesn't use leverage, so let's set that aside for now. Now, most of the time, most people trading futures are betting that the price of a crypto will go up. And this is just because over the course of history, crypto prices have gone up and to the right, especially large cryptos like BTC and ETH. And this begs the question of who's on the other side of that bet or of the trade. Logically, the answer is the futures traders who are betting that the price of crypto will go down. In practical terms, this means that traders betting that crypto prices will go up need to pay fees to traders who are betting that crypto prices will go down. And this is true so long as there are more longs than shorts. And I'll quickly note that going short also means you can lose money if the price goes up. And we'll come back to what happens when there are more shorts than longs a bit later in the video. Now, the key takeaway here is that when you short a crypto, you're earning a yield in the form of fees being paid by those who are going long that same crypto. And this is where most of the yield on Ethena's USDe stablecoin comes from. The other source of yield is the collateral, which is the second component. You see, most futures trading in crypto is done using a stablecoin like USDT as collateral. However, it's also possible to use another crypto as collateral. And this is where things get interesting, but also a little bit complicated. Suppose you're shorting BTC using BTC as collateral and you're using no leverage, i.e. just 1 times or 1x. At first glance, this makes no sense. If you're using BTC as collateral, then if BTC's price rises by 1k, you'll gain 1k on your BTC collateral, but lose 1k on your short position. The same is true in reverse. If BTC falls by 1k, you'll lose 1k on your BTC collateral, but the short position gains 1k. So zero change in profit or loss. So at first glance, the strategy looks pointless. But upon closer inspection, however, you remember that this strategy earns a yield because your short position is earning fees from the traders going long. At the same time, you've hedged against the volatility. Your position stays the same regardless of BTC's price. Now imagine this setup, but on a scale of billions of dollars, involving multiple cryptos and not just BTC. In Ethena's case, it also supports yield-bearing cryptos like liquid-staked ETH. And this means that its stablecoin doesn't just earn a yield from the fees on the short positions. It also earns other yield like staking rewards. According to the Ethena dashboard, 46% of USDe's collateral is made up of BTC, 20% is made up of ETH, 11% is made up of various forms of liquid-staked ETH, and the remaining 23% comes from various stablecoins. All these cryptos are being used as collateral to short crypto on 5 exchanges, generating yield from the fees paid by traders going long, while keeping the underlying value of these positions stable. Notably, all this crypto being used as collateral is not kept on exchanges. It is held by 4 separate crypto custodians. It's also important to note that the reason why Ethena uses these cryptos as collateral is because there's lots of futures trading happening on them. And that's why, for example, Ethena is adding Sol to the mix. So, to recap, Ethena stablecoin is backed by a combination of crypto collateral held with custodians and an equivalent value of short positions on exchanges on those cryptos that earn fees from traders going long. Some of USDe's crypto collateral also earns yield, and both yields are passed on to USDe holders. Technically USDe stakers, but we'll come back to that in a second. And this begs the bigger question of where exactly USDe comes from and how it maintains its peg. The answer is the third component of how Ethena works, and that's the users. For the purposes of this video, it's useful to think of Ethena as having 2 types of users: institutional users and regular users. Institutional users are the only ones that can mint and redeem USDe, and they must complete KYC to do so. Regular users can get USDe by swapping it for some other stablecoin like USDT, and they do not need KYC to do this. Institutional users will mint and redeem USDe based on user demand to maintain its peg. If the demand for USDe is high, then it will depeg to the upside, i.e. it will be worth slightly more than $1. And this creates an incentive for institutional users to mint USDe and sell it on the open market at a profit for some other stablecoin. And this selling brings USDe's peg down to $1. Behind the scenes, this involves depositing the supported type and correct amount of crypto collateral into Ethena. This crypto is then sent to custodians and an equivalent short position is opened on exchanges. And once this is done, an equivalent dollar value of USDe is minted and given to the institutional user to sell. On the other hand, if the demand for USDe is low, then it will depeg to the downside, i.e. it will be worth slightly less than $1. And this creates an incentive for institutional users to buy USDe on the open market and redeem it for a profit relative to the underlying asset and short. And this buying pressure brings USDe's peg back up to $1. And behind the scenes, this involves withdrawing the supported type and correct amount of crypto collateral from Ethena. First, the equivalent short positions are closed. Then the crypto collateral is sent from the crypto custodian to the institutional user in exchange for their USDe, which is simultaneously destroyed. And this begs the biggest question of all, and that's where the demand for USDe comes from. The answer is the 12% yield that can be earned from staking USDe as SUSDe. Naturally, SUSDe takes 7 days to unlock, and that's to ensure that there's enough time for shorts to be closed and collateral returned to Ethena's institutional users if there's lots of USDe redemption. It's also to ensure minimal volatility in the process. And this is where things get even more interesting, but even more complicated. To quickly recap, the yield on SUSDe comes from the yield on the collateral like liquid staked ETH, and from the fees being paid to the associated short position coming from the traders going long, assuming there are more longs, of course, than shorts. If there are more shorts than longs, then the shorts start paying fees to the long. Of course, this would be a problem for Ethena because it means that the protocol could owe money to exchanges in the form of fees. Thankfully, Ethena has two lines of defense, and the first being the yield on its crypto collateral. So long as the yield on Ethena's crypto collateral is higher than the fees being paid for the short positions, then the protocol will stay solvent. If the yield on the crypto collateral isn't enough to pay these short fees, Ethena also has an insurance fund with $46 million and counting, which can, of course, cover this cost. What this means is that USDe is unlikely to experience issues even when crypto is hitting its bear market lows. It's also important to note that supply and demand dynamics with fees for longs and shorts also creates an incentive for USDe holders to adjust the supply in accordance with the yields. Put simply, the more shorts there are, the less attractive it becomes to mint USDe, because the lower the yield there is for staking it as SUSDe. And notably, this sets a sort of a natural limit on how large USDe could grow, because the more USDe grows, the more shorts there are, and the less yield SUSDe offers. You with me? Cool. Now, this all relates to the Ethena token. ENA is an ERC20 token on Ethereum. It is currently used for governance and can be staked to earn additional yield and rewards in the Ethena protocol. Oddly enough, only one governance proposal has been passed so far, but we'll come back to that a bit later. Anyways, ENA had an initial supply of 15 billion, which was allocated as follows: 30% to ecosystem development, 30% to core contributors, 25% to investors, and 15% to the foundation. Note that 5% of the ecosystem allocation went to the ENA airdrop, which you'll recall happened back in April. The vesting schedule for ENA can be seen right over here. Now you'll notice there's a sizable increase in vesting across all allocations starting next year that lasts until the end of Q2. And you'll also notice that the supply will be fully vested by mid-2028, which is surprisingly short given the apparent long-term potential of Ethena. What's not surprising though is ENA's price action. In retrospect, it launched at the worst possible time, at the peak of the crypto rally in the spring. And as a result, it's been down only since then. To add insult to injury, it seems that ENA's supply has grown quite a bit in recent months, as evidenced by its rise in market cap. When you realize that ENA already has a market cap of over $1 billion, it doesn't paint a very bullish picture for the token. For context, it's ultimately the market cap that determines how easily a crypto can pump or dump. The larger the market cap, the harder it is for a crypto to pump or, of course, to dump. The bigger problem is that Ethena doesn't exactly have a narrative that the average investor can understand, much less ape into. The biggest problem Ethena has, though, is that this lack of understanding means that most investors just assume USDe is another UST, which just isn't true. Unfortunately, this doesn't change the fact that this is how most investors currently view Ethena. Fortunately, there's one thing that's stronger than narrative when it comes to investing, and that is revenue. Believe it or not, but Ethena could generate the most revenue of any crypto project ever. And this is because it's sourcing real yields in the form of fees paid by traders going long and additional yields from its collateral, be it from staking or otherwise. In this case, it really helps to put things into perspective. Stablecoin issuers like Tether and Circle are earning around 5% on their collateral. Meanwhile, the Ethena protocol is earning close to 9% in real yield, not worthless Ponzi tokens being printed out of thin air, as is the case with most other high-yield DeFi protocols. With over $2.5 billion of collateral, this works out to protocol revenues of over $200 million per year, which is quite frankly nuts. And the craziest part is that Ethena's protocol revenue will rise as the crypto market starts to rally. And that's because more traders will start going long. And more longs means more fees paid to short traders, which includes, of course, the Ethena protocol. Consider that long fees were generating yields as high as 40% in March. And this means that Ethena could earn billions of dollars in protocol revenue between now and the end of next year. Now consider what would happen if a governance proposal was passed to use a portion of this enormous protocol revenue to buy back and burn ENA. It would grow exponentially with the market. ENA could theoretically grow up to 50% more than the crypto it's using as collateral, in percentage terms. And this is because the amount of leverage in crypto grows anywhere from 30 to 50% more than the market cap of crypto in a bull market. And this is one of the many fascinating things that Guy has revealed in interviews. Not our Guy, the Ethena guy. Anyway, you could argue that Terra's Luna is a good proxy for how big ENA could grow during this bull market, as they are both decentralized stablecoin protocols despite being technically different. Take a second to consider that Luna grew to a market cap of $40 billion. So that could mean a 40x for ENA, or probably closer to 30x if you factor in all of the vesting. Whatever the case, if you want to maximize these ENA gains, then be sure to check out the Coin Bureau deals page. With trading fee discounts of up to 70% and sign-up bonuses of up to $100,000 on the best crypto exchanges, you will be able to squeeze every last drop of green from ENA. This juice is only available to Coin Bureau viewers and won't be around for long. So check them out in the link down below. Now, whether or not ENA can pull a 30 or 40x pertains to its upcoming milestones. And as it so happens, Guy published a 2024 roadmap for Ethena back in May. It consists of 3 milestones, which are, quote, reshape and force the convergence of DeFi, CeFi, and TradFi. Don't worry, it's simpler than it sounds. On the DeFi front, Ethena hopes its USDe stablecoin will become dominant. In fact, Ethena's own documentation seems to strongly hint at the fact that it's looking to disrupt USDC's dominance in DeFi. For reference, USDT is used primarily for trading, whereas USDC is used primarily for DeFi. And this ties into the CeFi front, where Ethena aims to disrupt USDT's dominance. And this sounds far-fetched, until you realize that Bybit has already added USDe as collateral for leveraged trading. Now recall that USDT is used primarily as collateral for leveraged trading, and Bybit is one of the largest exchanges for futures. It goes without saying that this could result in some wonky incentives, given that USDE is practically backed in part by short positions which can now be opened using USDE, but more on that in a moment. And this results in the TradFi front, where Ethena hopes to face off against the, quote, final boss, of course competing with US government debt for yield. Ethena's reasoning for this is that USDE amounts to something like a decentralized internet bond, a yield-bearing asset fundamentally backed by crypto plus a short hedge. This sounds delusional, until you realize that Ethena first wants to prove itself by facing off against the mini-boss, which is tokenized RWAs. FYI, most tokenized RWAs are US government debt or treasuries, and Guy argues in the roadmap that they will, quote, never be a category that brings meaningful new capital into crypto. He admits that achieving these ambitious milestones will require more than a decentralized stablecoin. It will require a network that makes it possible to move around and not just within crypto. This is what Ethena's new network is all about, and it seems to be in the early stages as it just launched an X account. The only other milestone worth mentioning is one that's implicit in Ethena's design, and that's the fact that it's likely to add additional cryptos as collateral if their futures markets become big enough. You might remember me, of course, mentioning how Ethena will soon be adding Sol for this reason. All we're wondering is how Ethena's involvement in futures markets could impact the crypto market. And this, of course, brings me to the challenges that Ethena faces. And all of them relate to the known and unknown incentives that Ethena could create within the entire crypto ecosystem. Whereas Terra was mostly limited to DeFi, Ethena is fully integrated into both DeFi and CeFi and is slowly expanding into TradFi. Look no further, for example, than Ethena launching a new stablecoin backed by BlackRock's Biddle Fund for evidence of that. Anyhow, all the ways in which Ethena could warp incentives in crypto could justify a video on its own, and you've probably seen many videos and articles that detail these risks. I mean, heck, even Ethena's documentation has a deep dive into all the risks involved and how they're being mitigated. The one risk that everyone seems to have missed, however, is that Ethena is likely to incentivize unprecedented levels of leverage on exchanges and elsewhere. From our perspective, this is likely why so many crypto exchanges are on board with Ethena, and if we're right, then it's a cause for concern. You see, what happens in crypto is that the amount of long leverage grows to a point that the fees become so expensive that traders who went long start to close these longs, of course causing prices to fall. So tell me, what happens when you have a protocol like Ethena keeping these long fees artificially low? In case you forgot, Ethena generates most of its yield from the shorts on exchanges, which are paid fees from the traders who are, of course, going long. When the amount of longs increases, so do the fees. And this increases the yield on SUSDE, which incentivizes more people to mint USDE and stake it to earn this higher yield. Behind the scenes, this involves depositing crypto as collateral and opening an associated short position on an exchange. As we've learned, the practical effect of increasing short positions is that fees being paid by longs decreases. And here's where things become truly fascinating and a lot more complicated. When the crypto market is chopping like it has been since March and investors expect it to continue being flat, then it makes sense for Ethena's institutional users to use BTC to mint USDE. And this is because the yield they will earn on staking that USDE will be comparable to the expected BTC returns. And keep in mind that USDE demand also comes from other users. However, if the crypto market is starting to enter its parabolic phase like it could be right now, then it makes no sense to use volatile assets like BTC to mint USDE. And that's because potential returns you'll get for trading BTC are likely much higher than the returns you'll get for minting USDE and staking it. This is especially true when you realize that when these institutional users redeem USDE, they only get back the dollar value of their collateral that they deposited plus any yield. For instance, an institutional user could deposit 10K worth of BTC to mint 10K USDe. BTC's price doubles, but they can only reclaim 10K plus any additional yield of that BTC. This is precisely because Ethena also opens a short position against the BTC being used as collateral. The value of the BTC collateral doubles, but the BTC short loses half of its value. As a result, there's only 10K worth of BTC that can be redeemed by the institutional user, which is a bad deal during a bull market. What this means is that Ethena's institutional users are likely to start using stablecoins as collateral to mint USDe, as the value of other forms of collateral like BTC starts to go parabolic. Besides the fact that this will increase Ethena's reliance on centralized stablecoins, it massively inflates the stablecoin supply. And all the while, the corresponding shorts for this stablecoin collateral are keeping long fees artificially low across the bulk of the futures market, which you'll recall primarily uses stablecoins like USDT as collateral. And this makes it possible for an artificially large number of long positions to open on exchanges. We don't know what could happen because of this. All we know is that Ethena will inevitably incentivize an unsustainable amount of stablecoin-backed long positions due to the inevitable use of stablecoins as the primary form of collateral in Ethena, which will of course keep fees for all long positions in crypto low. We all know what happens when you have large futures open interest, melt-ups and melt-downs. Add an excessive leverage to a market already so volatile could be a risk more generally. But having said that, it is a tail risk. Numerous outcomes have been modeled by Ethena's team, and so far the protocol has stayed robust through some pretty trying market conditions. So while UST was a castle built on sand, USDe is built on some much more solid foundations. Solid enough for USDe to challenge the big boys of the stablecoin space? Time will tell. But the generally rather dull world of stablecoins is likely about to get a lot more interesting. And that's all for today's video. If you learned something new, smash that like button to let us know. If you want to keep learning about the wild world of crypto, subscribe to the channel as well. And if you want to help others learn about Ethena and how it works, be sure to share this video with them. As always, thank you very much for watching, and I'll see you in the next one. This is Nick, out.